If you grabbed a coffee at Tim Hortons this morning and a burger at Burger King last week, you gave money to the exact same parent company without realizing it. Add in Popeyes and Firehouse Subs, and you have all four of Restaurant Brands International's brands. One Canadian incorporated, Toronto-headquartered company, trading on both the TSX and NYSE under the ticker QSR, sitting behind some of the most recognizable storefronts on the continent. This video is the complete dedicated breakdown of that company, what it actually does, and the business model is not what most people assume, the real numbers behind its dividend, and how safely covered that dividend actually is. Which one specific brand inside this four-brand portfolio is currently the weak link dragging on an otherwise genuinely strong quarter, and exactly how a Canadian investor should think about this stock for tax purposes. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. The core structural fact that changes how this entire company should be evaluated. Restaurant Brands International operates through 6 reportable segments: Tim Hortons, Burger King, Popeyes Louisiana Kitchen, Firehouse Subs, International, and Restaurant Holdings. But the overwhelming majority of individual restaurant locations under these brands are franchised, not company-operated. This means RBI itself, for the large majority of its locations, does not run the day-to-day restaurant operations, hire the staff, or directly bear food and labor cost inflation. It collects royalty fees and advertising contributions from independent franchisees who own and operate the actual locations. Why this asset-light structure matters directly for evaluating the company's financial profile. This franchise royalty model produces a fundamentally different financial profile from a company that owns and operates its own restaurants directly. Royalty revenue is a small, stable percentage of franchisee sales, largely insulated from the restaurant-level cost pressures, rent, labor, food costs, that a direct operator would absorb. This is the specific reason RBI's own reported operating margin of 26.8% in Q1 2026 is considerably higher than what a typical restaurant operator running its own locations directly would report. The scale, current as of mid-2026, RBI's market capitalization stands at approximately $33.51 billion, with the stock trading around $73.44 within a 52-week range of 61.33 to 81.96, employing approximately 53,500 people directly, a figure dramatically smaller than the total employment across all its franchised locations combined, precisely because of the structure covered above. The headline growth figure for the most recent quarter, directly from the company's own release, RBI's system-wide sales growth accelerated to 6.2% in Q1 2026, up from 2.8% in the prior year quarter. System-wide sales, meaning total sales across all franchised and company-operated locations combined. The top-line growth figure that ultimately drives the royalty revenue covered above. Your action step: before evaluating any restaurant or retail brand company's margins or stability, check specifically what percentage of its locations are franchised versus company-operated, because a heavily franchised company's financial profile should be evaluated more like a royalty and licensing business than like a direct restaurant operator. The current yield and dividend sourced directly. RBI pays a quarterly dividend of $0.65 per share, with a dividend yield reported at approximately 3.4% to 3.65%, depending on the specific share price used. Over the past decade, RBI's dividend has increased by an average of 21% per year, with no material reductions to payments. A genuinely strong long-run growth rate for a company of this size. The payout ratio and what it actually tells you. RBI's dividend payout ratio, measured against earnings, sits in the high 70s to low 90s% range depending on the specific period measured, meaning the company distributes a substantial majority of its net income as dividends, leaving a comparatively tighter cushion than a company with a payout ratio in the 40% to 50% range would have. This is a genuinely tighter payout ratio than many other well-known dividend-paying Canadian companies, and worth taking seriously rather than glossing over. Why a tight payout ratio is not automatically a red flag for this specific business model. As covered in Segment 1, RBI's royalty-based revenue is unusually stable and predictable compared to a company directly exposed to restaurant-level operating costs. A high payout ratio on a highly predictable, contractually secured royalty income stream carries different implications than the same payout ratio on a more cyclical or operationally volatile business would. The relevant question is not simply how high the ratio is, but how stable and recurring the underlying earnings actually are. The forward-looking context that matters most for judging sustainability. Earnings per share are expected to grow by approximately 32% over the next 3 years, according to analyst estimates. Growth that, if it materializes, would naturally ease the current payout ratio over time, even without any change to the dividend itself, simply because the earnings base it is measured against would be growing faster than the dividend. The actual cash generation behind the dividend? In the most recent quarter, RBI generated approximately $200 million in free cash flow and returned approximately $315 million to shareholders through dividends and share repurchases combined, meaning a portion of shareholder returns is coming through buybacks in addition to the dividend itself, a detail worth noting when evaluating total shareholder return rather than the dividend in isolation. Here is the answer to the open loop from the hook. Which specific brand inside this 4-brand portfolio is currently the weak link, sourced directly rather than asserted? Tim Hortons, the standout performer with a genuinely remarkable streak. RBI's own Q1 2026 release states directly that Tim Hortons and International each delivered their 20th consecutive quarter of positive comparable sales. 20 consecutive quarters is 5 full years of uninterrupted same-store sales growth. A genuinely impressive, sourced operational track record. Separate coverage notes Tim Hortons specifically delivering 15 consecutive quarters of positive traffic growth. A related but distinct metric, measuring actual customer visit counts rather than dollar sales, with Canadian same-store sales growth of nearly 5% in one recent quarter, described as outpacing all competitors and the broader industry. Burger King, a genuine turnaround story, attributed to specific multi-year execution. RBI's CEO's own Q1 2026 commentary states the results reflect several years of hard work by our franchisees and teams to elevate the guest experience, driving stronger engagement and clear outperformance. Separate coverage specifically credits strong Burger King U.S. performance as a key contributor to the 6.2% system-wide sales growth covered in Segment 1, and notes the brand is leaning heavily on branded partnerships and in-store experience, citing a Mandalorian tie-in campaign specifically to support traffic and same-store sales. Here is the weak link. Popeyes. The same Q1 2026 results that highlighted Tim Hortons and Burger King's strength report. In the same breath, system-wide sales growth of 6.2%. offset by Popeyes' 6.5% comparable sales decline amid operational challenges. This is a real, current, sourced underperformance inside an otherwise strong quarter. Not a hypothetical risk, but an actual reported negative same-store sales figure for one specific brand within the portfolio. Separate Q4 commentary similarly notes Popeyes showing only signs of recovery rather than confirmed strength, language notably weaker than the confident, results-driven language used for Tim Hortons and Burger King. Management's own stated response to this specific weakness: RBI's leadership has explicitly stated they are addressing Popeyes' weakness through core menu focus and value strategy. Why this brand-level granularity matters more than the consolidated headline figures alone. Evaluating RBI purely through its consolidated 6.2% system-wide sales growth figure, without looking inside that number, would miss both Tim Hortons' genuinely remarkable 5-year streak and Popeyes' genuinely concerning, currently negative trajectory. Two meaningfully different stories sitting inside one combined headline number. The straightforward tax fact. Restaurant Brands International Inc. is incorporated and headquartered in Toronto, dual-listed on the TSX and NYSE under the ticker QSR. As a Canadian corporation, its dividends qualify as eligible dividends for Canadian tax purposes, receiving the same eligible dividend tax credit applied to dividends from any other Canadian public corporation, designed to avoid double taxing corporate profit that has already been taxed once at the corporate level before being distributed to shareholders. What this means, practically, for a non-registered account: a Canadian investor holding QSR in a non-registered account reports the dividend income with the standard eligible dividend gross-up and corresponding dividend tax credit applied, the identical mechanism used for the bank, utility, and grocery stocks already familiar to most Canadian dividend investors. There is no U.S. withholding tax to account for here because RBI is a Canadian corporation, not a U.S. one. Even though its underlying restaurant brands operate extensively across the United States and internationally, the company's tax residency and dividend characterization for Canadian shareholders follow its actual corporate domicile. The TFSA consideration. Held inside a TFSA, RBI's distributions are entirely tax-free, exactly as with any other Canadian dividend-paying corporation. A separate, related security worth knowing about: RBI also has a related, economically linked TSX-listed security, Restaurant Brands International Limited Partnership, trading under the ticker QSP, a structure connected to the 2014 merger that created the company. For most retail investors, the straightforward QSR shares are the simpler and more commonly held route, with the standard eligible dividend treatment described above. Let's come back to where we started. Tim Hortons in the morning, Burger King last week, the same company behind both, plus Popeyes and Firehouse Subs, sitting inside one Canadian incorporated, Toronto-headquartered business trading on the TSX and NYSE. You now have the complete picture behind that ticker. An asset-light, franchise royalty business model with genuinely high operating margins because RBI collects fees rather than running kitchens directly. A dividend yielding roughly 3.4% to 3.65%, with a genuinely strong 21% per year long-run growth history, sitting against a real current payout ratio in the high 70s to low 90s% range, tighter than many comparable Canadian dividend payers, though set against unusually stable, contractually secured royalty income, and with meaningful forward earnings, growth expected to ease that ratio over time. Inside the four brands, Tim Hortons is delivering a genuinely remarkable 5-year streak of same-store sales growth. Burger King is in the middle of a credible, multi-year turnaround, and Popeyes is the real, current, weak link, with management having stated a specific plan to address it. And for Canadian tax purposes, this is simply a standard eligible dividend, taxed the same way as any other Canadian corporation's dividend, with no U.S. withholding tax complication despite the international footprint of the underlying brands.